The Internal Revenue Service (IRS) is widely known for its role in tax collection and enforcement, but many people are unaware of the full extent of the agency's powers. While most associate the IRS with sending tax bills, many are surprised to learn about its vast range of actions and capabilities. The IRS has the authority to enforce tax laws, investigate financial activities, and even take action against individuals or businesses that fail to comply with tax regulations. This article explores the top 10 things you might not know the IRS can actually do, providing insight into its far-reaching authority and the impact it can have on taxpayers. 1. The IRS can levy your bank accounts. One of the most powerful tools at the IRS's disposal is the ability to levy your bank accounts. If you owe back taxes and fail to pay, the IRS can seize funds directly from your bank account to satisfy the debt. This action is not taken lightly and typically occurs after several warnings, but it's a reminder that the IRS has the authority to go directly after your money in order to collect unpaid taxes. 2. The IRS can garnish your wages. In addition to levying bank accounts, the IRS can garnish your wages. This means they can legally require your employer to withhold a portion of your paycheck to be sent directly to the IRS until your tax debt is paid off. Wage garnishment can significantly impact your income and financial stability, so it's important to address tax issues before they escalate to this level. 3. The IRS can revoke your passport. Did you know that the IRS has the authority to revoke your passport if you owe more than $54,000 in unpaid taxes? Under the Fixing America's Surface Transportation (FAST) Act, the IRS can notify the U.S. State Department to deny or revoke a passport for individuals with significant tax debt. This can severely limit your ability to travel internationally and may require you to resolve your tax obligations before getting your passport reinstated. 4. The IRS can audit your tax returns years later. While most taxpayers believe that audits are limited to a few years after a tax return is filed, the IRS has the power to audit returns for several years. In fact, the IRS can audit a return up to 6 years after it is filed if it detects substantial underreporting of income, more than 25%. If fraud is suspected, the statute of limitations can be extended indefinitely, meaning the IRS can review your taxes at any time. 5. The IRS can file a federal tax lien against you. When you owe back taxes, the IRS can place a federal tax lien on your property, which can affect your credit score and your ability to obtain loans. This legal claim gives the IRS a right to your property to secure the payment of your tax debt. A lien can be placed on your real estate, personal assets, and even business assets if applicable. 6. The IRS can charge penalties and interest on unpaid taxes. The IRS not only demands the payment of back taxes but also adds penalties and interest to the amount owed. These charges can quickly add up, making the total tax debt much higher than the original amount. Common penalties include failure to file, failure to pay, and accuracy-related penalties. The IRS charges interest on unpaid taxes starting the day the tax is due and continuing until the debt is paid off. 7. The IRS can sue you in court. If you consistently refuse to pay taxes or fail to resolve your tax issues, the IRS has the ability to file a lawsuit against you in federal court. This is a serious step that the IRS typically takes after exhausting other collection methods. A court ruling can lead to the garnishment of wages, levying of assets, and other legal actions to collect the owed taxes. 8. The IRS can seize your property, seizure. If you have unpaid tax debts, the IRS can take drastic action by seizing your personal property, including real estate, cars, or other assets. This is typically a last resort, after multiple warnings and attempts to resolve the issue. Once seized, these assets can be sold at auction to satisfy your outstanding tax balance. 9. The IRS can place you on a payment plan, installment agreement. If you are unable to pay your tax debt in full, the IRS can offer a payment plan, allowing you to pay your balance in monthly installments. While this option can help alleviate the immediate financial burden, interest and penalties will continue to accrue until the debt is paid off. This arrangement helps taxpayers who are struggling to make large lump sum payments but still need to settle their tax obligations. 10. The IRS can discharge tax debts in some cases. In certain circumstances, the IRS can discharge tax debt through a legal process known as offer in compromise. This allows taxpayers to settle their tax debts for less than the full amount owed, if they can demonstrate that paying the full debt would cause financial hardship. However, only a small percentage of applicants are approved, and the process requires thorough documentation and negotiation with the IRS. The IRS is a powerful agency with a wide range of tools at its disposal to enforce tax laws and collect unpaid taxes. From levying bank accounts to revoking passports, the IRS has several mechanisms to ensure that taxpayers meet their obligations. However, taxpayers also have options to resolve their tax issues, including payment plans and offers in compromise. Understanding the extent of the IRS's power and the actions it can take is essential for staying in compliance with tax laws and avoiding serious financial consequences. If you find yourself facing tax issues, it's important to act quickly and seek professional advice to navigate the complexities of IRS enforcement and collection practices.